Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Nearly 20 energy executives meeting with President Donald Trump today to discuss rebuilding Venezuela's oil infrastructure. The lineup includes representatives from Chevron, Exxon and ConocoPhillips, among others. Also attending the meeting will be the U.S. Interior Secretary Doug Burgum, who joins us now. Mr. Secretary, welcome to the programme, sir, and a happy new year. Just frame for us the expectations for today's conversation.
Well, the expectation today is to have a great conversation about the opportunity to continue President Trump's agenda, which his agenda, of course, has been always about the safety and security, national security of our country. That begins with you can't have national security without border security. You can't have national security without energy security. So that's going to be on the table. And, of course, the prosperity of America. That's based on energy as well, because if without a plentiful, abundant, reliable, secure energy, you're going to have the inflation like we saw in the previous administration. President Trump is turning that around. So this is really at the core, it's a discussion about peace in the world and prosperity at home. And what an opportunity, economic opportunity to restore normal relations with Venezuela. And for companies, including many of these that had operations in Venezuela for decades ago, when Venezuela was a big economic partner to the United States before its collapse, get a chance to return to that. So looking forward to it. It's an exciting day and lots of interest in coming to the meeting today. There are not enough seats in the room in terms of executives that wanted to join in the meeting today with President Trump.
Secretary Burgum, I know that you and Secretary Ryder have that outreach with the oil industry right now, but what I'm hearing is that they are certainly lining up for a meeting with the president, but they're not necessarily lining up to go back into Venezuela. What are they telling you?
Well, I think the very strong interest. How can you not be interested in the world's largest oil reserves in the same hemisphere? So I think there's questions, of course, questions about security, questions about what the long-term profile is going to be, but the interest level is through the roof across from the small wildcatter to upstream, midstream, downstream, the majors. There's so much interest in this, and not just in energy. People are reaching out because the mining industry collapsed in Venezuela. Their entire electrical generation industry has collapsed. The opportunity with sanctions being selectively listed for the U.S. companies to sell into that market as it rebuilds is very interesting. And of course, we've got a number of energy companies that have spent their careers going into some of the world's dangerous places to develop oil resources. And those folks, some of those will be in the room today as well.
But it's going to take tens of billions of dollars for them to allocate capital to go back into Venezuela. Does the math make sense when WTI is trading below $60 a barrel?
Well, the market is going to decide, but I know that one thing that happened this week, people keep saying, oh, below 60, there's going to be no interest. Through the Department of Interior, we're holding our as required legal lease sales. The one that we held in New Mexico earlier this week on January 6th, $327 million of royalty payments and a record, the highest since these leases have begun under the new format. Almost 40 years, 39 years ago, in 1987 was when the new rules came in place. It was $219,000 per acre on one of the leases in Permian. So I would say the interest, U.S. And in Venezuela, very strong in this industry because they see, they look ahead and they see the demand for energy going up. And of course, driven by economic growth, 2026 could be a banner year, but also the energy required for us to win the AI arms race. So there's a strong interest in this investing in this Western hemisphere.
Does the administration have a goal of getting oil to $50 a barrel?
Well, I think what President Trump wants is he wants to break the back of inflation, and he knows that there's a component of energy in the food you eat, the clothes you wear, the car you drive. If you can get energy prices down, that's the best way to lick inflation, and affordability is something that matters. President Trump has stopped the runaway inflation, the prior administration. He wants to keep it going. When we talk about how do we get prices down, part of it is we've cut so much red tape in the last year. We've lowered the break-even point. That plus the technological innovation from this industry. The oil and gas industry is not what it was 50 years ago. This is a super high-tech industry. You take a look at my home state of North Dakota and you look at the capability and the productivity increases of the people developing there. It's just been amazing, the gains that they continue to make. And again, the shale revolution tied with deregulation, cutting some of the red tape that was put in place. We know that their break-even point is getting lower and lower, and that's why it makes it a great industry, and that's why we've got the greatest industry in the country, or in the world, because in the U.S. we've got competition. We don't have a nationalized oil industry that's become a monopoly and lethargic. We've got great companies that get out and compete. We're going to be with some of those great companies today, and excited to hear their ideas about how to go in and break free the incredible opportunity that is for both the U.S. and Venezuela in developing this resource.
Mr. Secretary, a lot to unpack there, including about the shale patch. I do want to stay on this question of U.S. backing of some of these U.S. companies going into Venezuela and building out the infrastructure there. President Trump has talked about potentially a $100 billion investment, potentially over the next 18 months. Where would the funds come from in the United States for some of these energy companies to help back those investments?
Well, the discussions right now have been that the capital is going to come from the capital markets and come from the energy companies. I don't see that these companies are going to need support from the U.S. other than things around security. I mean, if we can provide a secure, stable environment, the resource here is so significant and so large that it's going to be attractive for people to go in and develop that. And particularly as the U.S. maintains the embargo, this is key. You reported on it just now. President Trump, serious. I mean, sanctions under President Trump actually mean a sanction. The failed sanctions under the Biden administration just turned Venezuela and other places into the discount gas stations for China and other countries. And President Trump is, we're going to make sure that this is secure, and we're controlling the flow both of energy going in and energy coming out. Venezuela's heavy crude requires diluent. It requires a light crude like we've got in the United States to go down there. One barrel's got to go into Venezuela for every 5 barrels that comes out. Russia controlled that market. That market's coming back to the U.S. And the synergy between our refinery sector in the United States, which was built around Venezuelan oil, getting back to that's great news for refiners, great news for gas prices for Americans, great news for the opportunity to sell modern equipment to modernize this industry. So lots of news for beyond even the oil majors. Lots of great news economically as we open up this trading and normalized trading relationship with Venezuela.
Yeah, certainly Valero, as a refiner, has seen the benefits of this. Mr. Secretary, you talk about security guarantees, and if the safety is there, the oil majors will go in with, frankly, capital markets behind them. What kind of security guarantees are they asking for?
Well, we'll find out some of that more today, but I think what they really want to understand is, how serious is the U.S. in maintaining the embargo? How serious is the U.S. in maintaining stability in Venezuela? And I think the actions that they're seeing this week speak loudly to that. The actions of President Trump enforcing the embargo and already the cooperation. I mean, earlier this morning, President Trump, just in the last half hour, tweeted out that the Venezuelan interim government is releasing political prisoners. They're taking actions to demonstrate that they want to have a successful economic relationship with the United States of America. The interim government's committed that they're going to be buying equipment and material from the U.S. companies. I mean, these are all the signals that we're looking for to keep us moving towards normalized relationships.
Mr. Secretary, as you know, to establish stability in this region, it might require massive expense from the U.S. government, which might require a lot of money from taxpayers. If these oil majors go in with the support of the U.S. government, Mr. Secretary, would the president want a slice of that revenue for the U.S. government?
Well, I think President Trump is always looking for good deals for the American people, but he also is a business person. He understands that we have to have the right economic conditions for companies to go in and deploy their own capital and solve these problems. So I think in the end, what we're going to see is we're so fortunate to have a president who has got the willingness and the courage and the understanding of how to use force, just like past presidents did. I mean, we wouldn't have the Panama Canal without bold action by Theodore Roosevelt 125 years ago, and now under President Trump, taking a corollary of the Monroe Doctrine, which is saying, hey, if we've got criminal enterprises running countries and destroying countries in our hemisphere, that's bad for the neighborhood. Let's go in and clean it up and do that. But when it comes to rebuilding, I think, again, what we've seen is that if we can create the right market conditions, we're not going to need taxpayer dollars to go do this. And who's going to benefit? The taxpayers, because they're going to see lower prices at the pump here in America.
The reason I bring up this question, sir, is because, as you know, there was some conversation about chips being sold into China and the government getting a share of the revenue associated with those chips. And I wonder if the same kind of thing applies here, because I think the executives going into this meeting later are trying to figure out what kind of meeting they're going into. Is it an opportunity to explore Venezuela by themselves or alongside the US government? And what kind of agreement could be established further down the road?
Well, I think initially it's going to be alongside the U.S. government because, as has been stated publicly this week, the U.S. intends to control the disposition of the oil coming out of Venezuela. And as I said earlier, that it's going to control whatever material and supplies, and in this case, the millions of barrels of diluent that need to go in to extract this heavy Venezuelan crude. That is going to be controlled by the U.S. During this period in cooperation with the interim government in Venezuela. So I think that they can hear more about that firsthand today, but it's going to match what they've heard publicly this week. And I know from talking to a number of these executives this week, Chris Wright has talked to a number of these executives this week, there is a lot of interest in getting back into the world's largest proven reserves right here in our hemisphere. And again, that's a great benefit to the entire Western Hemisphere, but absolutely it's a benefit to the American citizens.
Stay with us. More Bloomberg surveillance coming up after this. Stephen Major, of tradition, writing economic data relative to expectations has softened. There is fundamental support to keep lowering the Fed funds rate to a level below where the forwards are currently implying. Stephen joins us now for more. Stephen, welcome to the programme, sir. It's always good to see you, and congratulations on the new seat. Let's talk about the data this morning. How relevant is the jobs report at 8:30 with your opinion in mind?
Well, I think your setup said it all, John. There's other stuff going on, isn't there? So there's the fiscal news perhaps coming through later, and everything else that's happening globally. So it's just one data point, and I think you've covered it pretty well. Regarding this one, what really matters is the evidence on about what all this does for wages, because I think there's been a clear trend these last few months where the path of wage growth is consistent with something nearer to the 2% inflation target. So what you want today is something that doesn't disrupt that, really. Of course, it's complicated because you've got the labour pool being affected by migration factors, and you've got some softening of demand for labour that's been evident in previous months. Overall, it's all very well looking at the unemployment rate and the payrolls number, but it's the bigger picture, how this fits into the bigger picture that matters.
Well, Steve, the bigger picture, I think, for many is that we've seen a notable increase in slack, captured by several data points. You point to wages, you can point to the unemployment rate rising more recently as well. There is a take on Wall Street at the moment, Steve, and I wonder if you'd push back, that if things stabilise, particularly with things like the unemployment rate, it closes the door on interest rate cuts. Do you see things differently for the year ahead?
I don't know about that, John, because so first of all, given all the things that have been happening, and you listed the surprises, the shocks that we've been experiencing these last few weeks, given all of that, would you have believed that the 10-year Treasury would have been in a range of 6 basis points, I'm told by my colleagues downstairs, 6 basis points this year, six whole basis points? In fact, it's been in a tight range for quite some time now, even before the start of this year. So I think that the bond market's holding in pretty well. If you got a strong data release today, something that indicated the economy was much stronger than we expected, I think the cynics out there might question whether the data was correct, in the same way that you could say if it was exceedingly soft. I think it's the broader trend that matters. You've got to smooth these numbers out over a period of time. I think the trend and the path is quite clear towards lower rates, and therefore there's an asymmetric bias in place. If you get a shock that says that the rates aren't going down, I don't think it's going to bother the market that much. But we're skewed towards opening the floor for rates and seeing how far they can go down. I don't see that many people talking about rate hikes anymore. It's only a few months ago that was being mentioned on shows like this.
Well, it seems like, Stephen, this is no longer a data-dependent market, as you just laid out, at least not a data point-dependent market, just because people have so many questions around the data. This is potentially a market, though, that could be roiled by events, and you mentioned some of them, including the IEEPA ruling that could come as soon as today. What kind of effect would it have on the bond market if the tariffs passed under the IEEPA rule in the United States were to be repealed, pushed back in any kind of way?
Okay, that kind of scenario is going to blow us out of that 6 basis point range. And the question is whether we would close still outside of the range or whether we'd still be outside of the range next week. Ultimately, we're looking at whether there is a path, I'm using that word path again, towards a fiscal number that is manageable. I mean, is it possible that the deficit is within a reasonable level? Now, of course, there could be some disruption to the president's plans, and it's clear there's a risk here. But ultimately, the bond market's going to clear. The auctions are going to get done. There's a question about at what price and at what cost, because the bond market's going to get done. I can assure you of that. The question is whether it's going to come at the expense of some other asset class.
Yeah,
that's really the issue, right?
Stephen, you keep talking about the 6 basis point gap, and you're right. I mean, even when you look at the move, the forward implied volatility index in 10-year Treasury yields, it's incredibly low. You aren't necessarily seeing much expectation for disruption. How do you know that this is resiliency and not complacency?
Yeah, look, that's a fair point too. Maybe we're all just so beaten up and already exhausted with the shock. I'll give you an anecdote on this. You're putting together my most recent piece. Like many analysts, you tend to go through it at the weekend. So I'm sitting there on a Sunday looking at the text. I'm thinking, oh no, with the news flow last weekend over Venezuela, I was thinking everything I've written here is irrelevant. But I came in on Monday morning and I was still able to publish it. Now, how is that possible? How could I have been so wrong with my judgment on the Sunday compared to the Monday? And I think that most of us are experiencing the same thing. Anyone who's involved in this market at the moment. So it could be that we're complacent, but it could also be with the fact that we're resigning ourselves to the reality that rates aren't going up and they're probably going to go down. So, as I said, I think the data is consistent with dates going down towards where the forwards imply and maybe less. And with some of the changes coming at the Fed, I would suggest that the balance is tipping to rates going even lower.
Well, a lot has already happened. A lot has already happened from Sunday, Stephen. The president this week has really taken a focus on the housing market. Even if the Fed continues to cut interest rates, is that going to help the U.S. housing market? Will that help mortgage rates?
Look, so what proportion is that money of the total stock of mortgages? It's not that high, is it? I haven't run all the numbers yet, but we're talking about a few $100 billion in a multi-trillion market. So I don't know how much of a game changer it is. Ultimately, getting the 10-year rate down towards 3 rather than 4 would be one of the best things that could be done for the housing market right now. So I guess the intervention that's just happened is going to help, but I haven't run the numbers yet. I don't know whether it's going to have a major impact.
I actually mean if the Fed cuts interest rates, is that really going to meaningfully help the mortgage market?
Thank you. I thought you were referring to the intervention for Freddie and Fannie. Now, if the short rate goes down another 100 basis points, the whole term structure is going to come down. The 10-year on current form isn't falling as much, but it doesn't mean to say it won't still go down. So it depends what the delta is between the rate cuts and the 10-year. I would suggest if policy rates go towards 2% or even less, then you could imagine that 10s are going to have a 3 handle and probably low 3s.
Final question, Steve. What's more likely at year end? That the 10-year yield is at 3% or West Ham is playing Premier League football?
That's an impossible one to answer. Look, John, based on the fact that West Ham are 7 points adrift, it's pretty obvious where the probabilities lie there. But you think things can change. It looks like a close call between the two, and I'm not gonna give you an answer if you don't mind.
Stay with us. More Bloomberg surveillance coming up after this. Priya Misra of JPMorgan looking for a cleaner read, writing the Bloomberg consensus of 70,000 and a decline in unemployment should mean the Goldilocks market pricing of low hiring, low firing can continue. Priya joins us now for more. Priya, good morning.
Morning.
Can the rate cuts continue?
Yes, I mean, if we get the Bloomberg consensus, does the Fed cut in January? Probably not, unless we get some big, much lower inflation. But look at the market pricing. Market's not pricing for the Fed to likely cut in Jan. The market has, though, 2 cuts priced in for the rest of the year. I think that pricing can remain because when we're looking at the totality of data, we're still not seeing hiring. Nothing in the fiscal stimulus in the One Big Beautiful Bill is essentially saying that companies are going to start to increase hiring. Look at this last week. Look at all the headlines that we're getting. Policy uncertainty is still high. So if hiring stays low and inflation comes down, in our view, you look at inflation across the board, whether it's shelter inflation, whether it's wage inflation, it's all heading lower. As inflation comes down, I think the Fed is going to say, okay, we can start to cut, a little bit more. I think the bar to cut rates is higher, but we do think that the Fed later this year is going to cut 1 or 2 more times. So I think that market pricing of that terminal rate stays. That's essentially what that 10-year is essentially banking on.
What is going to wake up this bond market, this very snoozy, range-bound, sleepy Treasury market?
I think it's great. I mean, interest rate vol has been extremely low. I think the president is focused on the 10-year. He's told us that before. I think what can wake the volatility up would be essentially if we get additional fiscal stimulus, not one big beautiful bill. If you get tariff dividends. Now, I'm not even sure post-AIPA that the tariff revenues will be as high. We do think that if AIPA is struck down, that the president's going to, essentially come up with AIPA-like tariffs under a different name. But, if there's additional fiscal stimulus, yes, then rates can rise. All those deficit hawks can come out. I think that's an opportunity. If you do get interest rates moving higher, any bear steepening in the curve, we would look to fade. I think the 10-year, in our base case, 375 to 4.25, I think that's the range we should expect for this year. If hiring continues to be low and firing starts to pick up, I think that's the tail risk here. I think the asymmetry in the bond market is rates are going to go lower. I think that's what nobody's talking about. Remember last year, all the narratives around the deficit, sell America, that's all way behind us. I think now we have to think about the 10-year being in a narrow range, housing affordability is a focus, and the risk is that if actually we start to see the layoffs, then rates can go lower.
So you think that the best part of the yield curve right now is the 10-year?
We do like the 5 to 10-year part of the rate curve. I think the front end starts to get really tricky. You have to have a clear view on inflation in the next month, on the unemployment rate. But when you're looking at the 5-year, 10-year, I think that's the part, number one, that impacts the housing market. That's the one that the president's focused on. That's the one that prices in the Fed to slowly get closer to that 3% terminal rate. So I think that's the one that we have more conviction in, that is likely to stay in a low range. And, I think that's what you own, particularly particularly if you own risk assets, if you own stocks, if you own credit, your biggest risk here is that the economy actually struggles because there's so much complacency about this Goldilocks continuing.
That makes sense to me. The hedge against some kind of falling off a cliff of the economy or significant deterioration. What makes less sense to me is that the Fed has room to cut rates because inflation is lower, and that will naturally bring the entire yield curve lower because of the wealth effect, because this is going to boost asset prices that much more, which will only encourage people to spend that much more. And you're going to see inflation in some of these higher end items, which is really what's been driving some of this. I mean, how do you square that?
So I think the K-shaped economy, the K-shaped market continues. So to your point, spending and if people are getting a refund check, they're going to spend it. Asset price inflation can stay high. But what we're looking at, what the Fed cares about, their dual mandate is PCE and full employment. That PCE number on inflation can continue to head lower because that's a function of shelter inflation, on how, housing, beyond housing ex-housing service inflation. Look at those numbers. They're slowly heading lower. The tariff effect is going to go away from inflation by the middle of this year. So I think, if you think about the rate cuts from the Fed, it was inflation in 2024. It was the unemployment rate in 2025. This year, you've got two paths through which the Fed can cut. There's that inflation part. As inflation heads lower, not asset price inflation, but PCE, which the Fed cares about, as we get close to 2, maybe it's 2.5, the Fed will feel more confident. The hawks that have been very vocal that inflation's above target, they're going to then step back and say, okay, we can, maybe neutral is closer to 3 and not 3.5. I think that's the debate we're going to have all year. What's neutral?
Priya, could we get your reaction to the president last night saying he's giving special attention to the housing market and telling his representatives to buy $200 billion of mortgage-backed securities and home loans?
I think it's great. Now we don't need just one thing for housing. Housing is an extremely complicated issue. If they need to fix housing, they need to fix the demand side, the supply side. I was a little nervous if all we were going to get was on the supply front. Now I think the president with this latest bit, and this does not need Congress. Now, the $200 billion is interesting. That's the amount that the agencies can buy relative to the cap. That cap can also move high. I think once they do the 200, the cap can be moved by the FHFA. And
I'm glad you brought that up because the cap is $450 billion. They've already been accumulating billions.
Right.
So this puts us pretty much right at that cap. But I spoke to a source last night and said, well, the Treasury and FHFA tried to lift the cap, and they said no. So if this just ends at the $450 billion, does it really do much for the housing market?
Well, I think if it's 450, it's $200 billion of net demand. And if you think about the mortgage market, the marginal buyer for mortgages is really asset managers. It used to be the GSEs pre-2008. Some of us were around back then. I used to cover the agencies. Then it was the Fed. Then it was U.S. banks. And now if you look at it, the banks are saying after SVB, well, we're not going to touch this. I think that's why the announcement is interesting. You bring a new marginal buyer in, other investors that might have stayed away will say, okay, the government's behind this, the agencies have the ability to buy, I think we can step in. But I will say, you ask about whether that's important, mortgage spreads can compress. But ultimately, if you look at the mortgage rate, it's the 10-year, that's the much bigger component. We have to keep the 10-year within that range. If the president's focused on housing affordability, so keep the 10-year 4%, 350 to 4, keep it there, and then get those mortgage spreads. We're talking 10 basis points. So, I get excited. I'm a bond person. Every basis point is very important. But I mean, to get 100, you're not getting 100 basis points in mortgage rates because of this, but it does help. Keep vol low and then get some mortgage spread tightening through.
This might just be the appetizer, not the main course. Is the Federal Reserve going to come along for the ride, along new leadership?
No, I don't think the Fed's going to do QE. I mean, there's talk around the Fed doing QE. No, the Fed is going to.
The Fed's working against this effort at the moment, aren't they?
Well, they are letting the portfolio run off. But I think what the Fed did in December, which was to say that let's make sure the plumbing works, I think that's important. They didn't let the repo market freeze up. So, yes, they're letting mortgages run off. The GSEs will easily offset that. I think on the Fed, what we really want is a credible, independent Fed. And I think, we don't know who the next Fed chair is going to be, but if you look at what the Fed's done over the last few months, they have reasserted that they're independent. This is a committee. The chair is important, but it's it's one vote. I think the Fed is doing, I don't know if it was, if that was an intended reason for them to be as vocal, but they're telling us that they care about their dual mandate irrespective of the chair. I think they're doing their part. They're keeping that term premium lower. Inflation risk premium, look at what's priced into the break-even market. It's low. The market's not concerned about Fed independence, rightly so.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.